Welcome back, everybody. My name's Anthony. Today we're going to be looking at Crocs stock. Now, I have run a DCF model on Crocs stock before. We have looked at this stock. It was a while ago, but I ran a 10% growth model on them out through the next 5 years. And the intrinsic value came close to around like $120 a share at that growth rate. By the way, disclaimer, I really like this stock and I really like this product. Here's the deal. To me, it's good to invest in a product that you like. I mean, that's a good thing. If you like the product, there's probably a good chance that other people like it too. However, in investing, we never become biased enough where it starts clouding our judgment in terms of investing in finances. So I look at Crocs stock each quarter that they have, each earnings that they report. And if I feel that something fundamentally changes with Crocs stock enough where I wouldn't be invested in it if it was another company, then I would be on the lookout for that. Guess I'm just trying to make a quick point before I get to the financials, that no matter how much you're in love with the stock and the fact that there is typically bias for your average investor once they're invested in a stock, don't make excuses for a stock if something changes. Okay, well with that, let's go ahead and look at Crocs and some of their financials. If you will join me on the screen here, we'll look at the last 5 years of their revenue, which grew from about $1 billion to $2.3 billion. I like that. That is good growth. You get your cost of goods sold here, which of course will go up with any business as you're producing more revenue and more gross profit. As long as your margins are staying the same or preferably getting better when it comes to gross margins. And you can see here that their gross profits have continued to go up, which would signify that their margins are probably staying good. But let's whip out the calculator on here and just take a little peek. Okay, so to get the gross margins for 2021, we would divide your gross profit of, let's call it 1.4 billion, just to make the math easier, and divide it by a revenue of 2.3. So, well, you know what? We could do all the numbers here, or most of them. Here, 1420 or 1.4 billion divided by the 2.3. Okay, boom. And with that math, we get that the gross margin is roughly 61.4%. Yeah, this is why one of the reasons I love this stock. It's a darn shoe company. They make rubber shoes, and I mean, that is a juicy margin for a company that's not a tech company. I mean, 61.4% gross margin. Yes. Now let's go ahead and see if it's gotten better over the years. Let's look at just 1 year before. We can do the basically 749. We'll round it to 750 divided by 1386. Okay, so about 54% for 2020. And in 2021, it was about 61%. Let's look at the year before that, in 2019. 617 million divided by, let's just call it 1230. 50%. Okay, so, I mean, this is the point I'm making. In 2019, the gross margin's 50%. Then in 2020, it jumps to 54%. And then in 2021, it jumps all the way to about 61% gross margins. You can see that the numbers are getting better and better. The revenue's increasing still a good amount. The margins are getting better and better. Let's take a look at some more stuff here. If you look at operating income, it also has increased through the years, just getting better and better. If you look at net income, it's gotten better and better. If you look at EPS growth, it's been phenomenal. Look, I mean, if I'm talking a company that's still growing pretty good, I want to see things like this. That's all I'm saying. I want to see that margins are staying the same or getting better. I want to see that operating income is increasing. I want to see that net income is increasing. And it's not showing it on the screen here, but their free cash flow has also been increasing. I want to see that the EPS is increasing, that they're making money, that they're becoming more and more profitable. This company is doing everything right, revenue increasing, margins increasing, profitability increasing. What more can you ask for from this side of it? Okay, that's fine and all, but we all know that that's never the full story when it comes to any stock or any company. We need to run our DCF model now, and we'll take a look and see what the intrinsic value of the company is. As I said at the beginning of the video, this is going to be a very, very, very conservative model. Just for the shits and giggles of it, I wanted to see what the value would come out as at 5% revenue growth. Do I think that Crocs is going to grow at a 5% average over the next 5 years? To me, that's laughable. The model I did before where it's 10% revenue growth, I think that's a lot more realistic, but I wanted to see with an extremely conservative model where we are sitting. And as we all know, when we run a discount cash flow model, we also need a free cash flow margin to apply to the projected revenues. This is, of course, to calculate our projected free cash flows into the future to help value the business. Now, the free cash flow margin when it comes to the last 2 years for their business, and where I really feel that they kind of hit an inflection point, it's 16% and 22%. 22% free cash flow margin was, of course, the last year they just had, 2021, because it was a phenomenal year for them. And their free cash flow grew like really, really well. So between 16% and 22%, I'm just going to go ahead and say I'm being relatively conservative by going with 15%. Okay, join me on the screen here for Crocs stock, which we are conservatively growing at 5% in this exact model. We grow it out to the year 2026, which comes out to about $2.9 billion. By the way, this is kind of just funny in how conservative this model is. This is laughable because the company itself is saying that they expect to reach $6 billion in revenue by this point. But okay, we grow out to about $2.9 billion in revenue by year 2026. We apply our free cash flow margin of 15% to all the projected revenues to get all projected future free cash flows. We get out to the year 2026 with $443 million. We need a terminal value. We can get that by applying a weighted average cost of capital. I use 9%, and you can get this figure from finbox.com. We applied a perpetual growth rate of 2.5%. Once we have our terminal value, you also have to apply our discount rate. The rate of return that I like to use is 12%. Once we get all those values after the discount rate of 12%, we add them all up. Add it up here, divided by shares outstanding, and we get an intrinsic value of about $87.69, or let's just call it $88 a share, fair value. Okay, look, people, so, I just love this stock. I love the company for the product, because I like the products, I like their shoes. We have like 5 or 6 pairs in our house right now, but I love the stock. Again, always be careful of bias, but in this point, it's not really bias. It's supported by the financials. A company that's growing revenues, a company that's growing margins, that's growing free cash flow, growing net income, growing operating income, you name it. And we ran an extraordinarily conservative model just to see what would happen. I don't think it's ever going to be as low as 5% over the next 5 years. I think 10% is being conservative in the model that I liked better, where it was more valued around $120 a share. Growing them at 5% revenue in this model, your intrinsic value is about $88 a share. According to the model, it's currently a buy, and that's based on a ridiculously conservative model. The stock trades at like $50 a share right now. Based on a 10% revenue growth model, you're at more than a 2x in actual value here, and you still have a lot of upside even if you're being extraordinarily conservative according to this model. Oh, and we didn't even look at the PE ratio, the price to earnings ratio, just for the shits and giggles. Let's go ahead and take a look on the screen here. Wow, for a company that's growing revenues very well, all margins going up, net income, you name it, all going up in a positive manner, a growing company, a great company. The PE ratio is 4.5. 4. That's ridiculous. You know, I didn't even look at this recently. 4.5 for a PE ratio. Are you kidding me? And you know, sometimes a PE ratio can be a little misleading because a company may be projecting to not do as well into the future. But Crocs stock is still like guiding to continue this growth they've had and do well. It's not often I talk about a stock like this, and I try to really keep this unbiased. And if you've noticed from my models, I always like to say, according to the model, this is overvalued, or according to the model, it's undervalued. And you know, I try to not give financial advice. I'm not going to ever tell anyone to buy a stock, obviously, but according to this stupidly conservative model, it's a buy. According to my more realistic model of 10% revenue growth rate, which is still conservative, it's a buy. I buy this stock every paycheck, and guess what? It may continue to go down with the market that doesn't, the market doesn't know what it's doing. It's bipolar right now. But it's mainly the market starting to not do well and a lot of bigger market cap stocks pulling the market down now. This is a stock that doesn't deserve to be going down. It's, in my opinion, and according to the model, extremely undervalued. And this is a stock that I buy into every paycheck. If you want to buy into a great company or any company that you feel is undervalued, but you're afraid of these market conditions, dollar cost average into your great stocks that you think are great. This is a stock, Crocs stock, that I am buying every paycheck, that I am dollar cost averaging into. I just love this stock. And this stock is going to make me a lot of money someday. Even if it's got to be 2 to 3 years from now, 5 years from now, this company is going to make me a lot of money. But in the meantime, everybody, thank you for watching. Safely invest out there. My advice is, if you find great companies you feel are undervalued in this weird market that we've got going on, dollar cost average into them. And if they truly are undervalued from a financial standpoint, I'd say that you'll be paid off with just a little bit of patience. Well, okay, everyone. Thank you for watching. Let me know your thoughts down below. And that's all I've got for you. And I'll see you in the next one.